Kai, welcome to the show.
Hey, Meb. Thanks for having me on.
It's good to see you again, buddy. I've enjoyed getting to meet you over the last few months, eating sushi, having a few beers. Where do we find you today?
I am in the great city of Brooklyn, New York.
What's the vibe in Brooklyn right now?
Vibe is good. We got good vibes down here. Everyone's moving down to Brooklyn. It's the place to be.
I used to make it to New York about once a quarter, and pandemic hit, yada yada. I'm due. This is like the best time of year. Spring in New York is like my favorite. So I'm currently displaced out of my house. I'm homeless. We're renovating, which seems to be not resolving anytime soon. So maybe I'll wrangle the crew and get to New York in the next month or two. I'd love to. You have to host me.
I think I owe you some sushi.
Good. Deal. I'll take you up on that. New York has great. New York and LA are two of the best sushi cities on the planet.
Yeah, we are very spoiled.
Yeah. Cool, man. Well, I just saw you in Miami, holding court at the recent ETF conference. Was that a good trip for you? How'd you find Miami? Was it just full of VCs and crypto meetings for you, or you're at ETF conference? You're ETF manager now.
Yeah, well, I may have been one of like 3 people who did the double header, did the Bitcoin conference followed by an ETF conference.
Pull the thread for me between the two. There was like 30,000 people at the first one and maybe like 3,000 at the latter one. What was the similarities, if any?
I mean, I was actually shocked by how much interest there is in crypto in the ETF community. Like, you tell me, hey, there's an ETF conference, I don't think crypto. But I mean, you saw that at the allocator hall, there was like half the booths were like Grayscale and other kind of disruptive blockchain style offerings.
Yeah. I think the challenge with the crypto community and the ETF side is you've had this sort of like waiting on Godot for, I don't know how many years it goes back. I have an old tweet where people were getting super excited about crypto ETF spot coming to market. And I was like, look, if anyone wants to make a bet that this makes it out by end of the year, so I was like, let's do a dinner bet. And no one would take me up on it. And I said, I prefer sushi. So I've been consistent over the past decade. I think that was in 2013. So we're going on like year 8 of no spot ETF in the US. So I think the ETF crowd is sort of like, a little frustrated and helpless, but hopeful at the same time. A lot of people doing some good work there.
Yeah. And each year that passes, we get 1 year closer to whenever it ultimately happens.
So listeners, we're going to go deep on a couple topics. Make sure you stick around for this entire episode because we're going to be touching on a few of Kai's papers. If you haven't, if Kai's new to you, you got to check out his company's website, Sparkline Capital. But one of my favorite new to me, I should say, thinkers over the past few years, he's got some really fun papers on an intangible value, which we're going to talk about, investing in innovation, which by the time this podcast hits should have dropped. Got a sneak peek. It's awesome. We'll talk about it. But we got to start, at the beginning with you, because I think, and I'm not certain, my producer will have to check this, we've probably had more alumni on this show from GMO than probably anywhere else. Research Affiliates is up there, AQR maybe up there. I'm trying to think, but you're an alumni, right? You originally started out at GMO. We're not talking Monsanto here.
No. My first job out of college was working for Jeremy Grantham.
And what was that? Like, you're like fetching coffee? How does somebody get a job right out of college? I mean, I guess you were local, but how does someone cozy on up to GMO?
I mean, it was more than just coincidence. So I actually I studied economics at Harvard and wrote my senior thesis on financial crises and bubbles with Professor Ken Rogoff. So it was kind of a natural segue to just hop across the river and start working with Jeremy and his team on that very topic, bubbles. You
start talking about bubbles, that's catnip for Jeremy. So, yeah. It's like you got a warm intro. Give us a rewind. What were some of the ideas and conclusions that you guys were looking at back then?
Look, on my thesis, the idea was, it was very like kind of Austrian, right? So it wasn't a super popular paper amongst the Harvard economic department at the time, But the idea is that imbalances build up in the economy, whether external, credit, asset price, what have you, and these things eventually need to unwind. And it's impossible to predict what will be the straw that breaks the camel's back, but you just know it will. And it turns out to be the case that we went through decades of data, basically pulling in every single crisis we could come up with. So Asia, Sweden, US, savings and loans. And what we found was that you could actually predict a higher probability of crisis when the imbalances had been built up prior to that. Very difficult to predict exactly how it all unfolds, but there is that predictive power.
I was just laughing as you're talking about your university thesis, because I was like, man, if you made me talk about mine, I'd be even remiss to even recall what it was about. But it's a funny reference because I was a biotech guy, and in my lab, and so this would have been 2000. So people were going to go in the Wayback Machine for a bit. And the funny thing about the University of Virginia is they're all archives. You can go pull up any engineer's thesis, including anyone who's attended, I guess, in the past number of decades. Anyway, but I had written mine about gene therapy, and I worked in a gene therapy lab focused on cardiovascular disease. And there was a very memorable day that I came into the gene therapy lab, and my professor was demonstrating and showing me like one of our prized viruses. And sure enough, he passes it to me. And if anyone's ever worked in a lab, there's the weird petri dishes where it's plastic and the top sort of overlaps the bottom. Well, of course, there was a fumble in transition in which I spill in the most dramatic fashion all of our prized virus all over the lab, but also all over the two of us. This was in one of those like, blocked off rooms. And so we spent like, I don't know, the next hour or two decontaminating the entire lab. And I always joke, like, fast forward to here we are with this virus and everything that's happening. I was like, rewind to me having this gene therapy virus that was targeting a cardiovascular that's jacked up my system 20 years later. I'm sure, just completing the circle there. Anyway, so listeners, I'll send you some Cambria swag if you go give me a book report on my thesis. If it's still there, I need to go steal it and just like take it off the out of the stacks. Anyway, all right. So you started GMO. What was your role? Like, so you're a probably 20-something, young 20-something. Were you able to contribute at all at that point, or was it kind of like, I'm here to learn and be a part of this team? Well, like, what were you actually doing? So and what year would this have been? Give us the timeline.
Yeah, I was super lucky. I joined in 2009. So this was after GMO had its best year ever, right? It made clients so much money betting against the GFC. And it was like one of those situations where it was a small team. I mean, there was only a handful of investment professionals, yet AUM was just kind of growing every month, $1 billion in, $1 billion. And I was lucky because I was the most useless person in the group, right? I was just like showed up out of college. I was like, hey guys, and everyone else, had real responsibilities, and I didn't. So what they did was they sent me on this like world tour, and I spent like 3 months in Australia, 3 months in London, 3 months in San Francisco, and then back to Boston, working with all like the teams that are specialists in macro and EM and various quant stuff, coming back, kind of bringing that knowledge to the mothership and serving as a liaison to those teams as we embarked on this project where we expanded our forecasts from equities to other asset classes. So, I kind of lucked into, being somewhat useful, merely because of my ignorance.
How fun, man. What a dream initial setup. I mean, granted, you top ticked like, the perfect time to join, but also at the same time, what a fun, just like absolute kid in the candy store opportunity. Okay. So at some point you decide to say, I've learned everything possible from GMO. It's time to start my own adventures. And then was this the entrepreneurship move out at this point? What was next?
Yeah. So end of 2013 is when I left GMO. And look, I mean, I loved the firm. I loved my coworkers and had a great experience there. Working for Jeremy obviously set me on the path as a value guy that I've gone down the rest of my life. But, I wanted something more entrepreneurial. So what actually ended up happening, and this is kind of interesting because it'll come full circle at the end of this conversation, is I actually got into crypto. So I started doing this like crypto trading strategy. This was like early 2014 when there were maybe 7 things you could trade. And, it was me and a few other people kind of sitting around, like trying to come up with ways to make money. And the crazy thing was that, you read those market wizards books and you have all these like classical arbitrages that were just like lying around in like 1980. Well, it turns out you could do those in 2014 crypto. Like we were doing these FX triangle trades where it was like, Bitcoin, Litecoin, like Doge or something. And you would look at the different pairs and figure out if there was a mispricing. Or even today, liquidity is ultra fragmented still across various exchanges. Well, back then it was the case as well, but also there was no one really sitting there trying to arbitrage. So it's like, gold in London versus gold in New York, that trade. So you could do all this, but then what ended up happening was I kind of decided at some point that like we were still too early. That look, the market cap of all of crypto at the time was $8 billion. And we were years away from like the serious institutions coming into the space. And then I had the opportunity to join up with a guy who was leaving from my former team. And we co-founded a firm in Boston called Kaleidoscope Capital. I was there for 4 years, setting up the firm, from going from scratch to, $350 million in AUM, and, good experience. And then in 2018, left to kind of start my solo project, which is Sparkline.
Awesome. That's a fun journey. I remember back to those days of crypto. I mean, we had a crypto payment option on, I was down in Mexico City at a conference and was chatting with some people that were early in crypto. And I said, you know what, I'm going to start to dabble in this. And we put a payment option on our Idea Farm research service, and no one used it. And my mistaken approach to it at that point was that, that my audience is the use case, or at least the early adopter use case. I was like, my audience is pretty tech forward. I'm surprised they're not using this. And then we eventually took it down. I'm kind of sad because for a long time I was like, I wonder if people actually paid in Bitcoin, and I just never paid attention to the wallet. And I was like really hopeful there was going to be like $2 million in there. To my knowledge, there is. But humorously enough, that same Mexico City trip at the same hotel, I rode up in the elevator with Dwight Howard and James Harden. There was some exhibition game. It was the strangest trip of my life, but awesome as well. All right, so Sparkline was the origin story for Sparkline. Similar at the time? Is it as it is today, or was it a crypto focus? What was kind of the inspiration on going solo?
Look, the big thesis that we have at Sparkline, so crypto is something we kind of got into later and, kind of came full circle, but really the big thesis at Sparkline is the idea that the economy is becoming more and more intangible, right? Human capital, brand, intellectual property, network effects, that these are the assets that now power the economy, yet most people don't correctly value them or undervalue them even because they're just so hard to measure. And so that's really been our focus. And what we realized is that accounting data is kind of insufficient in being able to measure these things. And what you really need to do is to go beyond into artificial intelligence, unstructured data, social media, patents, Glassdoor, LinkedIn, these sorts of things. And in order to do that, you really need to invest heavily in technology. Since, it's not so simple as like taking a bunch of like 10Ks, the text, and like throwing them into a linear regression. You really need to build like actual cutting edge infrastructure. So after I left Kaleidoscope, the first year and a half, maybe 2 years, was 100% heads down. Let's build out the research platform that will allow us to do whatever we want. And it, now it's crypto as well, but was equities initially and still is equities. And the idea was, look, I'm so lucky because I now, am a mid-career. I have no employees, no clients, no portfolio. All I can do is I can sit here and like focus on building out like the next generation research platform. So I did that, and that's kind of where we are now.
All right, well, good. We're going to spend a lot of time there, but what was the, as you look back upon this journey, was there an inspiration that really pushed you toward this concept of intangibles? Were you reading a paper? Was there just a day where you're just sipping coffee at your local hipster Brooklyn coffee shop, or I guess today that would be what, like a matcha latte. Or was it something that just is kind of, was a slow build up over time? Like what was the kind of foundation where you built this kind of concept from, and then we can lead that into your paper on intangible value.
Yeah. So the big problem that I tried to address is this question of the so-called death of value, which I'm sure you're aware of. It's this notion that, it's no secret that value strategies, and in particular quantitative value strategies, have massively underperformed the past 10 years. And you have people saying, oh, value is dead. Now, look, I've been a value guy my entire career, and I've thought a ton about this issue. And the conclusion I came to was that, look, value is not dead, right? The idea of buying low, selling high compared to some measure of intrinsic value, that's like by definition true. The problem is that the metrics we use as to what is value that need to be adapted. So you think back to like when Graham and Dodd wrote Security Analysis, 1930, the economy was totally different back then. It was industrial. The biggest companies were railroads and steel mills. And more importantly, value back then was tangible. So as a value investor, all you had to do, again, easier said than done, but all you had to do was find companies that were trading below net liquidation value and buy them, right? It's cigar buy. It's pretty straightforward. Obviously, acquiring the data was a lot more challenging back then, but at least conceptually not that hard. Now, fast forward 100 years to today, and we live in the information age. The biggest companies are Google and Amazon and Apple, and these companies don't require net tangible assets to produce earnings. They rely on human capital, on IP, on brand, human and network effects. So, and despite the rise of the intangible economy, right? Intangible capital is now over half of the capital stock of the S&P 500, and this trend is just only going to keep increasing over time. Despite all this, accounting has basically done nothing. I already mentioned this, but they don't. Accounting does not capitalize R&D or advertising. So normally when you create a factory, if you invest in building some tangible physical assets, it goes on your balance sheet. Well, if you invest in R&D, it doesn't go on your balance sheet, it comes out of your earnings, right? That seems inconsistent. Or think about human capital. The only human capital disclosure in the accounting 10Ks is headcount, right? But we live in a world where CEOs are saying people are our greatest asset, yet they can't bother to disclose anything more than the number of people on their balance sheets. So that just seems completely ludicrous. We kind of realized at some point that accounting data was a non-starter, and we had to transcend that, which is why we went down this path of linking the kind of machine learning AI skill set that we developed as quants back into the fundamental idea of trying to fix quote unquote value investing and try to bring intangible assets into this definition of value. So that really is the genesis of this concept.
You have a great quote on your website from Uncle Warren Buffett, but it says the 4 largest companies today by market value do not need any net tangible assets. They're not like AT&T, GM, or Exxon requiring lots of capital to produce earnings. We've become an asset-light economy. As you look back, is there a particular sort of time or regime when this transition? I mean, I obviously it occurred over a period of years, but is there a certain kink in the data or time where you think it becomes more meaningful to incorporate this?
I think it really started accelerating in the 80s and mid 90s. But what happened was there was this weird dislocation with the tech bubble where things just got so overdone and then had to come back and get released that it's kind of hard to look at the data and really draw conclusions because that's such an outlier period. So then if you put that aside, it's really 2005 and on, where once you start incorporating these metrics, you get a much better result than if you were to stay with the kind of tried and true book value, price to book value metrics and realize that it kind of had stopped working.
Yeah. All right. Well, so let's say one buys this argument conceptually. Let's walk through kind of the paper, how to think about it. What's the framework for, as you say, challenge accepted in this paper? What's the framework for how to incorporate and think about this?
Yeah. So we start from first principles, and that is what if you sat here with me and say, hey, Kai, let's brainstorm what are the intangible assets that might matter today? And then try to say, can we collapse that list into the smallest number, the fewest pillars possible? such that we could span the entire universe. You come up with a list similar to what I did, which is there are 4 pillars of intangible value: the IP, brand, human capital, network effects. And that's just first principles, I guess, without looking at any data, doing any data mining, etc. So now we say, okay, now that we know what matters today, or we think we know what matters today, can we actually measure that, right? Can we actually say, all right, well, I want to figure out like how strong a human capital of Goldman Sachs is. How can I do that? So each is so heterogeneous, and I've done a dozen papers now. Each one's a deep dive on a specific thing. But I think the best way is just through examples.
Let's do it.
So yeah, human capital. One of the papers I wrote focuses on the use of LinkedIn. And LinkedIn is super interesting because it gives you a record of everyone's kind of employment today, but also all the way back through time. So a time series, which allows you to track the flows of talent from company to company. And we use this to answer 2 questions. So the first question we answer is, how are companies able to attract and retain top talent? The idea being that if I am able to poach the top engineers from Apple and bring them into my company and then keep them happy so they don't turn over, that should be a good thing, right? And how do you measure that? So what we do is we actually go into LinkedIn, form these graphs where you can see, where human capital is flowing, say from Apple to Microsoft to Facebook to Sparkline. And what we do is we use PageRank, which is the Google algorithm that's used to do search. So PageRank is this idea, and this is Larry Page's original invention that is behind Google search, that the strength of a website is a function of its backlinks. And to the extent it's getting a backlink from like Wall Street Journal, that's better than getting one from some like random blog.
Yeah.
We can do the exact same thing here, where it's like getting, say, a computer vision, PhD who went through Google, and before that was like Carnegie Mellon. That's like really good. But getting, somebody from like, maybe your local IT support, help desk is like less valuable. So that's the first thing we do, is look to figure out which firms are able to attract and retain top talent. And the second thing is trying to dispel this idea of like AI theater. So this is the idea that like every CEO it's become very like trendy for CEOs to get up there and say, hey, we're doing like a digital transformation. We're investing in like the blockchain and like cloud computing and like Internet of Things, and kind of throwing out all these buzzwords. But like if everyone does it, then you don't actually know which firms are like, BSing versus like truly are investing. So the idea is, can we figure out like when CEOs are putting their money where their mouth is? And so we'll get into the patent data like later on. That's obviously one way. The other way is to look at human capital, because if you truly care about AI, you're going to be hiring people with like TensorFlow and PyTorch on their resume. If you truly care about blockchain, you'll be investing in folks with like Solidity. So these are all like skills that are mapping to the space and help give a sense for which firms are truly willing to pay the premium to get, say, a top MIT trained NLP engineer.
I like the phrase you used on your website of quantifying dark matter, because to me, a lot of this is things that people, like you say, they may talk about and discuss, but they're not necessarily actually quantified. In some cases, it may not be, it may be misleading at best.
Yes, let's do one more example.
We can do all 4. I love listening.
We can do all
to
of
them. Come on, I got plenty of time.
We have here. You want to do a 3-hour podcast?
Yeah, we just dropped one. We just recorded one with Chris Bloomstrand, and that was like 2 hours plus. But that just means you're having a good chat. So we'll see if you can hit the 2-hour mark. So let's go. Tell me some more.
All right. So here's another one: is brand. Now, there's the way we frame this is, if you think back to like Mad Men, right? We used to sit around and watch our TVs and be told by the guys in the suits on Madison Ave like what to buy. Mm-hmm. But today, the way that brand perception is being shaped is on social media. So what we're really doing now is, listening to a third-degree connection who happens to be an influencer in matcha lattes, talking about what he or she is drinking, and then we go buy it. So as a investment manager, if you want to quantify the brand of a company, you need to go to the room where it happens, which in this case is social media. So what we do is we scrape Twitter and we say, all right, let's get like all the tweets, millions of tweets associated with all the brands that we have in our universe. And then what we say is, can we create brand profiles, brand personality profiles for each brand? So for example, we say, Christian Mingle is sincere. WD-40 is rugged. Tesla is exciting, right? There's these 5 dimensions, kind of like a Myers-Briggs style, like radar chart. And the insight is that it's not so much what you're known for. It's more like being known for something that matters, right? You think about the apparel space, like, Lulu, like Nike, these brands all have like, really like passionate followers because they, are known for a specific thing. And the key is, being known for something that puts you in the kind of a brand map, unique from your competitors. So we do all this work, kind of figure out the personalities, figure out how they look next to their competitors. And we find that the stocks with the strongest brands do tend to outperform. So this is like a factor we can add to our models. So that's an example in the brand category. Another thing, you mentioned the notion of, these things that everyone says are important, but no one's measured. The best example there is culture, right? Everyone quotes this notion that like culture eats strategy for breakfast. Everyone says, hey, look, if you have a good firm culture, that's all that matters. But the question is like, are these CEOs just saying that? Are they just kind of ex post creating a narrative for why they were successful when really they were, insider trading or something, right? So we wanted to be the first study to actually show a connection between firm culture and future stock prices. And the way we did that was we went into Glassdoor, right? Because again, the same problem with AI is the CEOs love to talk about how amazing their culture is. No CEO is going to say we have a bad culture, but that is, has no correlation with the actual experience of the rank and file, the day-to-day employees. So we go to glassdoor.com. And this, for those who don't know, is like a forum where it's like a Yelp kind of, where people can leave reviews on their employers or former employers. And we scrape all the reviews. And what we do is we first find, so we have a few findings. The first finding is that the star rating, so people can give a rating between 1 and 5, is not actually that important. It doesn't really predict that much. The second finding is that the text of the reviews is better. And you can do sentiment models where you train supervised learning models to say, hey, is this text positive versus negative? That is somewhat predictive. But what was the most predictive was actually creating, similar to what we did with brand personalities, creating these profiles for firms on a handful of different dimensions. So what we did was we said, what are the dimensions, what are the values that companies care about? And if you go on all the websites, companies' websites, and like tally up like how many times are they mentioning integrity, et cetera, you find that like the first thing is integrity, then you have like innovation, teamwork, all the way down. And so we say, can we take each reviews and figure out which, on what dimensions each companies are strong? And so you might find that certain companies are really known for innovation, others are really known for being very team-oriented, et cetera. And what we find is that firms that are strong on these main values actually do outperform. That culture actually does matter in this case.
In your paper, which is a little outdated, not outdated, but it came out a year ago, you give some notable intangible companies. Are there any that you think stand out as being, positive in this category, and or if you want to say that there's any that are particularly negative?
Yeah, so the point of this, right, was to try to contextualize the model, right? Our goal here is to not create like a black box, like some quant black box. What we're trying to do is create like transparency and, have intuition mapped to like what we own. So it's like, hey, the idea was NVIDIA. What is the reason? Why are they on this list? Why is NVIDIA like strong? Well, it's because of their IP. Their IP is what gives them a moat against other competitors in chip space. Moderna obviously has the mRNA patent, things like that. On the brand side, we find Nike and Harley, Human Capital, Goldman, Regeneron, Network Effects, Amazon, Twitter. And look, all we're saying here is it's not so much are these guys attractive in absolute, but more what is the primary driver of each of these business, without making any judgment as to whether or not that's a long or short in general.
How did like it's interesting too, because certainly brand, as Buffett describes, and some of these things that are a little squishier, but that you're trying to quantify, can be pretty time dependent too. I would argue that the sentiment, maybe perhaps surrounding Robinhood, is different today than it would have been, I guess, prior to them being public, but a while back. And Facebook has certainly seen its ups and downs, and thinking about scandals and one-off events, and also employees retention and getting fired. Saw Robinhood was laying off a bunch of employees today. How often are these models updating? Is this something you're looking at once a year, once a quarter? Is it daily? Like, what's the frequency with what sort of information is being ingested and spit out?
Yeah, we update these models every day. So as new tweets come in, as new reviews are posted, as people change jobs, that information is kind of in real time being fed into the models.
Yeah. As Elon's buying Twitter, by the time this publishes, who knows what is even going to be happening with that, by the way. It seems to change on the daily. But so as we're kind of, cobbling together this concept that you're talking about intangible value, and some of these kind of four horsemen, intellectual property, brand equity, human capital, network effects. Are there any more areas of this we haven't covered before we talk about how the sausage gets made on incorporating these into sort of a composite concept?
Yeah, so on that front, the key here is that this is a value strategy, right? We're not just going to go out and buy the companies with the most patents or the most PhDs. We're going to look for companies that have a high number of PhDs or patents relative to their market cap. Right? That by normalizing everything by price, that's what makes this a value strategy. So we're not going to go out and buy Tesla. Why not? Well, Tesla is a very innovative company, right? But the problem is it's just so expensive that it's very difficult for these models to get comfortable with that valuation. And so by doing it, it's similar to how classical value investors look at different yields, like dividend yield or price to book, but just replace those fundamentals with intangible value metrics, and then you end up with our portfolio here.
I was laughing because I was just reading your paper and you're talking about sausage getting made. So let's and hopefully Impossible Foods, they get a new sausage out. I haven't tried it, but I'm a shareholder, so I love pushing their probably terrible for you, but not.
Well, let me know how that goes.
Yeah, their nuggets are amazing. Anyway, I posted on Twitter right before we started this a funny picture where I was at Legoland, and so I probably have like all 5 COVID variants now, but I was laughing because there was a buffet that had this big sign where, well, meanwhile, all the other buffet stations were like, if you could come up with the least healthy possible thing on the planet, and like in a kitchen, there was Fruity Pebble pancakes, which I saw, which was incredible. But anyway, there was one station that was labeled healthy choices or something, but I was laughing because it was full of bagels and bread. So this like harkens back to the investment, the food pyramid of my childhood, where it's like, eat a bunch of pasta, cereal, and bagels, and you'll be healthy. Just whatever you do, avoid fats. Just funny how the views have changed over the years, and it seems like what you're talking about is relevant. The views of how to think about value, how to think about innovation, and some of these concepts that others kind of subjectively talk about, you're starting to quantify. So, okay. So, do you approach this like we think a lot in terms of portfolio composition and thinking about strategies like this? Do you approach this where you look at each silo independently, and then you're kind of looking at the universe as a whole, or you come out with like composite metrics for each company? How do you start to rank order the entire universe of what it means to be a intangible sort of value strategy versus the opposite?
Yep. So we obviously have dozens of different metrics. I think we talked about a few here, but we only have 3 hours for this podcast, so won't go through all of them. But the idea is that we take all the metrics and for each pillar, kind of smush them all together to an average. And the reason you do that, by the way, is to deal with correlations. If I have a metric like number of PhDs and another metric like number of patents, those things might be correlated. And so you want to kind of deal with like those sorts of issues. And anyways, so you create these 4 pillars. And so now you have 4 numbers, and then you do just kind of sum them up simply. The idea being that we're not trying to make any judgments as to is IP more or less important than brand in the modern day, but kind of like bottoms up, like follow the fundamental value through the economy as like the world potentially changes or doesn't, right? Like network effects are an interesting example because they become more and more powerful with the rise of the internet, right? When like, shopping malls, I always say, are a form of network effect, form of platform company, but you had maybe a few thousand people go through a mall, whereas like now on Facebook, you have 6 billion people go on, right? So that like drastically accelerates the role of network effects, and you can see it in the data kind of emerge and increase over time. And you want to allow that to happen organically and not like constrain it being like, oh, well, I'm always like equal weighted, or I'm always going to put 10% into network effects because that would, forego that opportunity.
So the cool part about the paper is you start to show some strategies where you take this intangible value concept and you can take it back decades. So my first question on this is, have you reached out to Fama and French, see what they think about this? You pass this paper along? Are they open to this concept and evolution of some of their ideas, or what's the reception been?
I don't actually know Fama and French. I know they had a 3-factor model. Now they have a 5-factor model. So,
soon to be 6, the Kai
exactly.
Wu factor. Well,
Yeah.
to get, you gotta muscle our buddy Wes and get an intro, because he's friendly with those peeps. So anyway, I was just saying, because so much work has been built upon some of their ideas. I mean, DFA built a $400 billion business based on this concept of price to book alone. I feel like, and correct me if I'm wrong, you probably know more about this than I do, I feel like they recently were writing about how they're not just using price to book anymore as a value metric, but considering other ideas. Does that sound familiar, or did I just make that up?
I would love to hear that. I don't know.
Yeah. Well, I'll Google around as you're talking on this one. But anyway, so walk us through some of the conclusions on how this portfolio strategy has behaved. We got the conceptual idea, but what's the actual outcome for this type of strategy over the decades?
Right. So the point of this is to get outside of like the style box framework and to get away from this idea that, oh, there's like value stocks and then there's growth stocks. This is what Warren Buffett said, that value is joined and growth are joined at the hip. We want to, have a model that again follows the value, through the economy, and maybe value one day and maybe growth another day, just depending on where fundamentals go. So right now the portfolio is heavily invested in what you might call like new economy sectors. So semiconductors, media, software. And that makes sense because that's where economic activity, especially in the US large cap and mid cap space, is concentrated. If you were able to backtest this 100 years, which I can't, you would almost certainly see the sectoral composition change. As remember, railroads were the technological marvel of the 1800s, right? They were kind of growth stocks. And so you would kind of see it move. But the really powerful thing here is that, yes, this portfolio does tend to own new economy sectors, but it does so in a way that's still very cognizant of price. So if you look at the, say, valuation ratios, you find that the price to earnings and price to book ratios are similar to the market. And more importantly, if you look at things like R&D divided by price or PhDs divided by price, these intangible value ratios, the portfolio is like 2x as attractive as either the S&P, the Russell 1000 value, or the Russell 1000 growth index. And the key here is like, why is that? That seems weird. Well, look, the value index doesn't hold any FANG stocks, doesn't hold any technology stocks. If you don't give Google credit for its IP, you're never going to hold Google. It's always going to seem expensive, right? So of course, there's no intangible value there. If you go to the growth section, then you're like Tesla and you're like Moderna. And these companies, yes, they have a ton of IP and human capital, et cetera. But because the valuations are so high, the amount you get out per dollar put in is actually not that special, which is why, we have like a 2x compared to all three of these metrics. And I think that's really the crux of this portfolio, is you're getting exposure to new age, kind of disruptive, forward-looking companies, but doing so at a reasonable, if not attractive price.
So for those listening, as they tend to think about, the strategy is historically beaten both. But as you think about the traditional framework of a value investor, growth investor, this is interesting because it has elements of each, right? It has companies that may be bucketed more traditionally as growthy sort of sectors and industries, but also value characteristics. Do you tend to, when you talk about the narrative of this strategy, do you tend to put it in a comparison of one or the other, or it's totally kind of its own animal?
Yeah, I think it's eye of the beholder. For those of us who are used to thinking about value strategies, this is a way of applying value into non-traditional areas, right? High intangible companies. For those of us who are used to investing in growth-like companies, this is a way of maintaining that exposure to the future while being a bit more cognizant of price. So I think, and for those of us who are kind of your, DFA kind of factor investors, this is potentially a sixth factor, or maybe, a ninth factor, let's say, that folks can potentially tilt towards if they do buy the argument that these intangibles tend to be undervalued because they're so hard to measure.
Well, it's fun because you have in your paper, which we'll link to on the show notes, on intangible value, you have fun charts of factor exposure breakdowns. So with S&P, Russell value growth, and then intangible value. But it's fun because you see it in the, like you said, price to patents, price to PhDs, some fun factors that most may not have seen before. Does the strategy constrain in any way as to industries or sectors, or theoretically could be all in on railroads, like you mentioned?
Look, I used to be a hedge fund guy, so I'm very familiar with factor neutralization, long short investing. We were very deliberate, though, when we built the strategy to not do any of that and let the exposures grow bottoms up. And that's for two reasons. So first is I don't really buy the whole GICS classification. I think it's obsolete, right? Of the 5 FANG stocks, only one of them is an IT stock. And you have plenty of disruptive companies that are not classified as IT, and then plenty of legacy tech companies. So I just don't think it captures the factors we're going after in the modern day. And I would much prefer we were to classify companies into 4 buckets along the 4 intangibles. So that's the first reason. And the second thing is that even let's imagine we do buy the notion that these GICS classifications are the be all and end all of what is a sector. Well, take the example of green energy. So imagine we were to say there's 5% exposure to energy today. Let's just fix that forever. And then let's say a year from now or 10 years from now, green tech became the biggest industry in the US. Well, and it's 40% of the market cap. Well, it's too bad. You're only going to own 5%. So it just doesn't make sense, I don't think, to overly constrain this portfolio and instead let the notion of intangible value drive the allocations.
Yeah. You went the extra step, man. You eventually launched an ETF, the Sparkline Intangible Value ETF. Listeners, ticker ITAN, great ticker. And for people who are interested in this sort of strategy, and what it's up to, what kind of positioning? I mean, here we are in 2022. Things are getting weird, just like they were in 2020 and 2021. I'm waiting for a break. I'm ready for a quarter, just to for it to be kind of mellow. But that's markets. It's always exciting. You decided to launch an actively managed fund with some friends of ours. You want to tell us a little bit about the process? Was this as exciting and mind-numbing as you thought it might have been? More fun, less fun, more headache-inducing? How's the experience of launching a public fund been?
Definitely different. I never saw myself as an ETF manager. And this is how the story goes, actually. So I posted a blog on our friend Dan Rasmussen's blog. This was beginning of COVID, I think. So world was about to go into a lockdown. And Wes reached out and he goes, hey, dude, like, do you want to start an ETF? Like, have you ever thought about doing an ETF? And I was like, why would I do that? I'm a hedge fund guy, like what? But, we started talking and like, we did a bunch of calls and, he was really, persuasive when it comes down to like, hey, if you're going to put money into a strategy yourself, don't you want to wrap it in like a tax wrapper, right? This idea that you can kind of wash out capital gains and defer tax-free those gains until you sell is just such a tremendous advantage over time. I mean, it doesn't make a difference if you're going to hold for like 6 months, as many people in ETFs do. But if you're truly oriented of like a buy and hold investor in an active strategy you believe in, and you plan on holding it for a long period of time, like why wouldn't you put into an ETF? It's almost a no-brainer. And so that's really what persuaded us to go down this path.
Exactly how Wes would have phrased it is, hey, dude. We're referencing Wes at Alpha Architects, former podcast alum, as well as Dan at Verdad, another podcast alum. What's funny, look, man, you the power of writing and research, has been a great example. I can speak to it personally, as can you. Putting out awesome research like you guys have has led to a fund and hopefully many more. I want to spend most of the time on your new paper, but as a quick segue, we got to talk a little bit about Web3, your paper there. Give us the ideas and thoughts on that one, and what's going on in that world. What'd you learn in Miami?
So
and by the way, no one, I think your choice of titling this paper a Value Investor's Guide to Web3, like that's some good SEO, because no one's combining those two phrases, right? Value investing,
because nobody's doing it. It's antithetical.
Thinking about that, no one. There's just going to be like the one result and then blank afterwards. So, all right, tell what's a value guy doing in crypto land? Let's talk about it.
Yeah. So look, I came out with all this research on intangible value, mainly focused on companies. And the feedback I got from many, but not all, but many people was, hey, that's really cool. This seems really cool. It'll work in equities. But what I'm really trying to figure out right now is like, what's going on in crypto? Like what's going on in Web3? And the really powerful thing about the intangible value framework is that it can be used in non-traditional areas. I always call it value investing in weird places. So the idea is that most traditional value investors are like, well, if it doesn't have cash flows, if it doesn't have book value, then I can't invest in it. Which is why like technology and biotech and all these kind of more intangible intensive sectors have generally been avoided by traditional value investors. And again, that's why ITAN exists. Now move to the crypto space, same problem exists here, which is the crypto markets are dominated by, trend followers, narrative driven investors, and the value camp, right? The kind of staid folks, all my friends from Boston, they don't go into crypto because they don't feel comfortable that they can assess and ascertain a measure of like an anchor of fundamental value in the space. But here's the thing, which is A16Z, all these VCs are pouring tons of money into the space, right? In what way is investing in, Uniswap or any of these kind of, Web3 companies that much different from investing in the internet companies of the early 90s? Yes, they're early stage. Yes, they have yet to monetize. But at the end of the day, what you need to look for when you look for these companies is how good is their team? Do they have traction with users? Have they built a brand? Have they managed to bootstrap network effects? So it turns out that this framework of intangible value is powerful, if only because it's a way of establishing a value framework without requiring cash flows or any traditional metrics. So that's kind of why I went down the path of saying, let's expand the platform from just equities to also include cryptocurrencies. And
next insights, what as you started looking into that world, I mean, you obviously came from that world, but as you applied this new lens, what'd you see?
So I guess there's the macro and the micro. So the macro finding is, as you might expect, which is 60% CAGR in fundamental value over the past several years. So number of developers, number of folks with cryptocurrency wallets, amount of transactions going through the top protocols, Twitter followers, Tom Brady and Giselle are out there in the Bahamas right now talking about crypto. You think back to like 2014 when I was doing this, it was like me and a bunch of degens. And we are flipping, 7 different currencies amongst each other with like no real world use cases, right? You couldn't even buy the ideas farm with the Bitcoin. Yeah. And now here we are in 2022, and like everyone seems to be doing stuff in Web3. Snoop Dogg has an NFT, and all the developer talent has poured into the space. Like I was at a wedding not too long ago for a friend who's like a tech CEO. And so a lot of the other people there were, highly placed folks in tech and finance. And we were joking, it's kind of like the crypto conference in San Antonio, because, everyone was just talking about Web3 and, potentially going into the space or, already there. So, it just definitely feels like a lot of talent is moving there. And as an investor, you need to be following the talent. That's just like principle number 1, follow the talent. And, it's just so impressive to see over the past 6 or 7 years, how much growth there's been in this space. So that's the first finding, which is just like
always follow the nerds. That's for sure. And I say that lovingly as an engineer. I can say that. Okay, follow the smart people, follow the nerds. All right, finding 1.
Finding 2 is that these value metrics are actually useful, right? That they actually can be used to help us navigate what is otherwise a very treacherous asset class. So why is crypto so treacherous? Well, there are like 3 challenges. And what you want to avoid is showing up in 1995, predicting the internet and making no money, right? The equivalent could easily happen to somebody investing in crypto. There's 3 challenges. The first is just the sheer number of projects, the opportunity set being very big and being forced to pick winners, because we live in this world now, and in digital markets, it's the case that oftentimes only a few winners will drive the returns of the entire sector. So how do we avoid missing Amazon? How do we avoid, instead buying Webvan? And that's a big problem. And unfortunately, a lot of investors own Bitcoin and ETH, but not any of the long tail. Right? So what happens if Solana or something like that ends up becoming the platform of the future? And a lot of, VCs and other investors, lock up in the best projects today, but you need to be cognizant of the fact that with the ecosystem evolving so quickly, you might be missing, the new use cases as they arrive, and you need to be able to kind of rotate. So that's the first challenge. The second one is just the outright number of scams and the unevenness of the quality of projects. It's the case, unfortunately, that setting up like $100 million market cap crypto is like not that hard. Like you and I could just like do that right now. We'll just like fork some other repo and like boom, there we go. Buy some followers, like whatever. And that's really unfortunate. There are so many folks trying to cash in on the gold rush and starting like either straight up rug pulls or just hastily putting together projects that really have no use case. So that's the second challenge. And then the third challenge is just the volatility of this hype cycle. Right? Any emerging technology, not just crypto, but the internet and the railroads, right? They always go through these boom and bust cycles. So what you want to avoid is buying into a project at such a high valuation that even if it ends up being like around in 10 years, you actually lost money. It took you years and years and years to make your money back.
You had some great quotes, and we'll add them. But I love the Web3 is both a real industry and a bubble. And you kind of talk about the playbook.
There are 4 things, and they address the problems aforementioned. So the first one is diversification. This is the idea that you shouldn't just buy Bitcoin or ETH. You need to spread your bets across all these competing protocols and all these other use cases that could easily become the killer app. And it's not just about names, it's about sectors. Right, you have funds that are focused on metaverse or DeFi. Well, what if it turns out that DeFi is not the killer app of Web3? The second thing is to look at data. So I mentioned some of the data sources we use already. And this is a way of weeding out the scams, right? If a third of your 10,000 projects are just literally nothing, well, that will show up because you can go on the blockchain and see that there's nobody using this $1 billion market cap protocol. You can go on GitHub and realize they just forked somebody else's code and have made no changes. And it's just one dude like in Singapore in his mom's basement who is behind this. There's no community around the developers. So that's the second thing. The third thing is to look at valuation. We don't care about how many users you have. We care about how much you're paying to obtain those users. We don't care about how many Twitter followers you have. We care about how much you're paying. Like imagine you're a VC buying the enterprise value of this business to achieve these users. And in doing so, it allows us to filter out these firms, these projects that might be around in 10 years, but are just so overpriced it becomes very difficult for them to ever, make their investors profit. And then the final piece is to trade. So the idea here is, look, I'm a public markets investor, and I've oftentimes been secretly jealous of my VC friends because they have the opportunity to invest in these like world-changing, 100-bagger power law companies, and I can't. The thing is that crypto is super cool, especially small cap crypto, because you get the best of both worlds. You have the ability to get in early in these power law companies and also have liquidity. The problem is that most folks who approach it from the fundamental side are, VCs, people who are not used to liquidity or how to use it. And so we use it in two ways. The first is to course correct. And this is the notion that the best projects today won't be the best ones next year or in 5 years. And we want to be able to stay nimble and rotate the portfolio as new use cases and projects arise, and conversely fade as certain things start to like roll over in their usage. And the second piece is on the price side, right? So price to fair value, the numerator in this case. You're a value guy, that like it's all about Mr. Market, buy into, fear, sell into greed. Well, in this case, Mr. Market is like a raving lunatic. You have like a project that, might be fair value, and then, tomorrow some influencer tweets about it and it goes up like 200%, and it's going to come crashing back down. So what you should do is you should sell, take profits, wait for it to overcorrect, then buy the dip. So trading around fair value in this case is like a pretty nice source of returns. When I was at GMO, we actually did a paper called the option value of cash for our clients. And the idea was that the value of cash was kind of like a Black-Scholes model. And it was dependent, therefore, on the implied volatility of the opportunity set in the future. Well, in crypto, you have thousands of tokens with 100% implied vol, and some correlation that's not less than 100%. That's a pretty fertile ground to be harvesting this rebalancing premium, buying low, selling high in a value-oriented way.
So this isn't just a theoretical concept, and I definitely think it's a little bit outside my wheelhouse, but I love listening to this area and ideas, and particularly anyone who comes to it with a value lens, or I'm a trend follower at heart too, so I'll keep that in the room. Obviously this isn't going to be an ETF, at least not anytime soon, maybe one day. Tell me about, you launched a fund. Can we talk a little bit about it? Is the strategy? What are you guys doing, and how's it work?
Look, the strategy is very similar to what we've just discussed and the research here. I don't know what I'm supposed to say about this.
You're supposed to say you're all in leverage 10x Dogecoin, and that's it, and it's a pair trade with short Twitter, Tesla, and but like how does it come together? Like what does the portfolio composition at a high level look like? Is this something that's trading like high frequency intraday, or is this more of like a quarterly sort of concept? Just give us some flavor.
Sure. Yeah. The strategy is a value strategy, and so it trades on a longer horizon. And similar to the ETF, right? I am a quant and I do use AI and machine learning, but the focus here is not on trying to, front run the next guy. It's on taking this fundamental intuition and scaling it as broadly as possible across thousands of cryptos or equities. So the turnover is going to be medium, I'd say. And since I didn't mention it yet, I mean, the key here is the data we use. So for example, GitHub is kind of one of the key sources here, whereby you can see, because Web3 is being built in the open, you can see like the status of the source code today. You can see it yesterday, all the way back to inception. And that allows you to form measures of IP that are like, how many iterations, how many changes, how actively are the developers changing the source code over some period of time. Another angle we look at, Mab, is to look at the developers who are then contributing this code, because you can actually see each time a change is made, who it is, or at least the account name of the folks who are behind it. So you can create metrics around developer community. how many developers are working on this project? Is it just 1 or 2 people, or is it like a massive, robust team of folks spread all over the world contributing their free time to this utopian vision? And then on the public blockchain side, it's this idea of being able to look at the ledger, and by definition, you can see it now, and figure out how many people are interacting with this protocol. So it's measures like daily active users, monthly active users, how many wallets, unique wallets hold this cryptocurrency. What is the transaction volume? What is the dollar transaction volume going in through any point in time? Right? Similar to like if you could open up like Visa's 10K on a daily basis and look to see an update in real time. Oh, how is this payment network being used? And then the third piece of data we look at is social media. Now, social media is important, not just in Web3, also Web2, obviously. But what makes it so powerful here is that because these companies are by definition borderless and decentralized, all of the coordination of the community occurs online in channels such as Twitter, Telegram, Reddit, Discord. And to the extent you can kind of acquire some of this data, you can see the amount of growth of each project's developer community and and just like online community in general, like its fans. And that's like a very powerful metric for brand and for network effects. So you have these different sources that are in many ways very unique to Web3 that allow us to ascertain the value of the 4 intangible pillars. And that becomes the kind of the core of the strategy, that once we understand and have ways of quantifying intangible value, we're really well positioned to be able to run a strategy around it.
And so what you end up owning, is it public securities? Are you owning the cryptocurrencies themselves? Are you owning other things? Like what's the how much does this differ from what like a market cap crypto sort of concept would be?
Yep. So I thought a lot about how to get exposure to crypto. Right? I used to be in GMO asset allocation. This is what we did. There are 4 ways of playing crypto. There is public equities, which you mentioned. So that's like investing in Coinbase or Silvergate. There's private equities via VC. That area has become extremely popular, A16Z, et cetera, very crowded. There is your Bitcoin ETH, so what I would call mega cap crypto. And then there's like the small cap token space, the kind of long tail everything else. And that is what we've chosen to focus on exclusively. So we're saying, let's not like try to commingle too many different things. We want to be a puzzle piece. And of all these 4 things, this is the area we think is the single most attractive space. Right? Think about it from an allocator standpoint. We can now invest, as public investors in an asset class with power law upside, right? If you buy Solana today, that's not interesting. You bought Solana 2 years ago, that was very interesting. And the next Solana lives in the long tail. We have liquidity. We can kind of rotate in an evergreen way as the ecosystem evolves. So we're not like kind of captive for 10 years into what the world looked like in 2022. And also the point of alpha, right? So, the lesson of, GMO was that that being early in the frontier is a huge advantage. So Jeremy founded GMO in the 70s and was one of the first guys doing quant factor investing, quant value investing, and was very successful doing that. Then he did it in international and small cap. In EM, became one of the biggest, GMO was one of the largest EM managers in the early 90s. And so the lesson there is you want to be on the frontier. And what is more frontier than crypto, and more specifically, small cap, long tail crypto? So it just stands to reason that there is a lot of inherent benefits of the beta itself, but also the alpha.
Is this accredited only?
Yes. So this is a private fund. We would have loved to do it as an ETF, but obviously that's not possible. So, and because of those standards, we're going to need, if you're interested, you would need to reach out to us to have a conversation.
Same as all the private funds on here before, listeners, email Kai, not me, pester him if you want to subscribe. I think it's a super cool idea. To me, all of investing, it's odd talking a lot about the value crew, old Charlie who's knocking on a hundo, his old quote about, fishing where the other fishermen aren't. To me, this is a pretty thoughtful way to approach an asset class that's growing. What are we at? Are we like $1 trillion in assets at this point, or is it more than that?
It's 2 trillion.
2 trill.
And the big thing that's happening is that as the market caps increase, so does the breadth of the market. So remember, in 2009, it was just Bitcoin. In 2014, it was like 7 things, and now it's 10,000. So what's happened is you've seen like a flattening of the distribution, where a lot of the mass is starting to move towards the tail, these smaller cap things where there's just a proliferation of use cases. So everything ranging from cloud computing, so decentralized cloud computing, to metaverse, NFTs, decentralized exchanges, all that activity is in the long tail. The other half is, the top 5 or so major cryptos, and they're the platforms, right? That's Bitcoin, digital gold, Ethereum, World Computer. But I think as an investor, what I'm very interested in is the, kind of whole layer down here of this long tail.
I feel like each of these papers probably could have and should have been an entire podcast. But I definitely want to reserve a nice chunk of time for your most recent paper, which I'm super stoked about. This one, listeners, you made it thus far, you get a free happy hour from Meb and Kai for sticking around. But to me, this is a timely paper. The word innovation has become, pretty buzzworthy the last few years. As you mentioned, you can kind of really talk about this concept throughout the history of public markets. I love to joke. I can't remember if it was railroads or utilities in the 1920s that got to a P ratio of 65. One of them did. Professor Schiller has a good paper on sector CAPE ratios. But just going to show that our grandparents, what today seems mundane, to prior generations is like a world defining idea and concept. So disruption, innovation from a value guy, let's talk about it. Walk me through the new idea of this paper.
Yep. So the big idea of the paper is like, what the hell is going on with disruptive innovation? Obviously everyone's talking about inflation and crypto right now, but if you step back and like look at a longer time scale, the big story in markets the past 10 years has been innovation. Software and technology are eating the world. Companies like Apple went from being a $1 trillion company a few years ago to a $2 trillion company today. Companies like Tesla went from basically being nothing to a $1 trillion company. So the world is clearly changing. And we've seen the entrance via SPAC, IPO, direct listing of a bunch of disruptive companies into the public markets. And it's this big tug of war between what many investors view as a new guard compared to like the legacy companies. And then what's happened is that fund managers have realized that it makes sense for them to launch products to package these innovative companies into funds. So obviously Cathie Wood and ARK, they're the OG in this space. They launched in 2014, their ETF. But since then, many other players have come into the space trying to get a piece of the action. The problem, right, is that none of this has really worked the past year. ARK's down 60%, Zoom, Teladoc, all these guys are down 80%. And it's ignited this massive debate, which is what should we do with our disruption stocks? Is this, as the defenders of innovation claim, a generational opportunity to buy world-changing companies at a deep discount? Or is it, as many of the detractors have said, just kind of proof that all innovation investing is a rebrand of growth investing? That this is something that folks have been trying to do for years, seducing the innocent retail investor into buying these story stocks and then getting destroyed when the bubble pops. Is that what's happening here? Are we about to enter a dot-com style winter in innovation? The goal was to approach this with an objective, kind of evidence-based approach. The first thing I had to do was to reverse engineer what is it that is innovation. And you think about what people who are innovative investors say today. They say, hey, there's like AI, there's blockchain, there's VR. You can kind of get a sense for what they're doing. Is they're saying, let's figure out what technologies are going to change the world and then buy the companies that have exposure to that idea. That's what they're doing, I think. So what we need to do then is to figure out, can we get a historical record of the technologies that have been world changing through history? And the good news is that we can go to the patent data and have all that information sitting in front of us. So the US Patent and Trademark Office, they maintain records back to 1790. The first patent was actually signed by George Washington himself, which is like a really fun piece of trivia. And since then, there's been exponential growth in the number of patents available. What we do is we say, can we, look at these patents and then cluster them according to the technology that underlies them, right? So it might be the case that a patent on like LiDAR and one on like image recognition, they're kind of related to this idea of autonomous vehicles. We kind of put them together. And then we try to see throughout the historical record, can we identify trending technologies? So my favorite finding is just this simple kind of, nerdy thing, which is we can actually observe through the past 200 years, the rise and fall of key technologies. Like we can see that railroads were really popular in the 1840s and then kind of diminished. Electricity started becoming a thing and then peaked at 1900. The automobile then rose and fall, followed by circuitry and computing, and then in the internet. Like you can literally see the major technological revolutions that have powered human civilization in the patent record. And I thought that was super fun, and also just kind of indicates that we're on the right track here looking at this data.
Well, in the paper, you talk a little bit about how essentially some of these technologies tend to trend rather than necessarily mean revert. And there's like an echo of maybe 3 to 5 years, but there are some false starts, maybe electric vehicles, et cetera. Can you expand on that at all? What's the kind of way to think about, the life of some of these, because some of these concepts and trends probably will last a really long time, and some will just wither away and turn into something else or die altogether.
Right. Yeah, I mean that's very much the challenge here, which is, does technology trend or does it mean revert? Right? That's the fundamental question we're trying to ask. The example of the car I thought was really cool, like the electric vehicles that, I didn't know this before really doing this research, was that the electric vehicle was actually like a best-selling car in like 1900. And it was competing with like steam and the internal combustion engine for market share at the time. And what ended up happening was, of course, the internal combustion engine improved fast enough that eventually supplanted electrical vehicles and then became the mainstream car. And then EV made a comeback again, like in the late 90s, 2000s, and then kind of faded out again. And then now with Tesla, I think it's finally time for it to shine. And really the problem with EV has been the gating technology of battery technology just hasn't really been good enough to give any kind of decent range until now. So we're now starting to finally solve these problems, which is kind of opening up the potential of the asset.
And by the way, listeners, we're not going to get into a lot of the fine details, but reading the paper, I think, is really cool. Like, on some of the specifics where Kai is talking about, like, the patent office, how they characterize technology groupings and the classification, and very specifically, like how a huge percentage of, categories are omitted and included. So if you're trying to do some work on this on your own, certainly read the paper, because it gets deeper than we're going to talk about today. He's glossing over what must have been an enormous amount of work that the team put together. And so one of my favorite charts of this whole paper is sort of like the greatest hits by decade, because I love like looking back. It's like the old movie with Dustin Hoffman, The Graduate, where he's talking about plastics, and looking back over time to seeing refrigerator and lasers, all sorts of fun stuff. What's the big ones today? What's popping up as some of the greatest hits of the 2020s?
So over the past decade, you can see the major technologies like cloud computing, social network, AI. One interesting finding here is that social networking became very powerful and very influential really early on, but it has actually started fading the past few years. So that's the one example of the modern technologies that is actually on the decline. Everything else is still growing, at least somewhat. Now, if you go down to the list, what you find is that the technology that is growing fastest is blockchain. There are now 900 or so patents over the past few years, with a growth rate of about 400% over this period of time. The next highest is AI. Now, AI has been growing for a long time. It is and has been a very important technology for a long time. It's a 200% growth rate from a higher base. Then we have quantum computing.
AI is like the granddaddy as far as the absolute level, right? Like that's, if you look at the kind of chart, that sucker is growing in a what's the Terminator T2000 sort of way. That thing is getting scary.
Yeah, and it has and it has potential to cut across all technologies. Right? That's why it's the biggest technology. It just has the most, the biggest TAM, so to speak. And we have quantum computing, 3D printing, Internet of Things, VR, autonomous vehicles, robotics. And then the last one is actually fun because that's cloud computing. And look, it's only growing at 28%, meaning it's a quote unquote mature technology, but that's still pretty decent, right? So even after all these years, and we've seen, cloud's been around for a long time now, it's still putting up pretty solid numbers.
There's you then kind of go a step further, and this is super fun. I mean, obviously a lot of these would be not that surprising to people, but others, it's interesting to me to see, and you guys have more of the data than we would, but the like 3D printing, which may have had hype earlier, but maybe still, a lot of development and maturity ahead of it, perhaps, who knows, on and on and on. But you then start to make the transition to connecting this with companies. And nothing in your paper, I think, is more hilarious to me than seeing the top blockchain patent holder being IBM. I was like, I think it's number 3 is Bank of America and 4 is Accenture, which is just sort of, it's not ironic, but it's fascinating to me. IBM, like how this stock, which is always the number one on, it's like, isn't it the number one in patents for like 50 years or something?
I mean, that's basically their business model at this point, right?
It's a giant patent troll database. But I think that's so humorous to me. When I saw that, I was like, okay, of course it's IBM.
Yeah.
So, all right. So tell me the next chapter, which is investing in innovation. How do you start to link this to actual companies or investable ideas?
Yeah. So the key idea here is remember what we saw in like the Dimson Marsh study, where it was like GDP growth is not necessarily linked to stock returns. That was kind of my approach here, which I was like, I don't know. I mean, there's no, like, if everyone knows that innovation is a good thing and that innovation generates progress and growth, it's not clear to me that that you as an investor in innovation have a God-given right to returns. Like, what would happen if the market just priced it, right? Or in the case of the growth investing argument, probably, overvalued it. Well, in that case, you're not going to actually make any money doing it. So it would have to be the case that the market is undervaluing these innovative companies in order for there to be a systematic return premium associated with innovation. I said, we now know, because we know technology is trend, that we can predict the future path of technology by extrapolating the past. So for each point in time, we're going to build a basket of, say, the top 10 technologies then. And what we'll do is we'll rotate over time into the next thing. You visualize climbing a series of escalating S-curves where you kind of always want to own them at the steepest part of the S, and then kind of roll into the next one as that technology matures. So that's very much the idea. We have 10 technologies at any point in time, and kind of that keeps recycling as the world evolves. So then the next step becomes, can we determine which companies have exposure to each of these disruptive technologies? The idea that's actually pretty easy to do, because each patent has an assignee, and you just need to map that back to its corporate owner. And so for any given arbitrary basket, you can say, all right, well, create a 3D printing ETF. Boom, one click of the mouse. I just go in, figure out 3D printing patents, figure out which guys own them, done, right? So we create these thematic portfolios, these 10 today, smush them together, and that's what you own. So there's 200 stocks currently, but that number has obviously changed over the course of time. Then what we do is we look at returns. So this goes full circle to the question we initially asked, which is, now that we have this backtest, where we use machine learning to classify patents into technologies, and then find the trending technologies, and then find the companies that are investing in said technologies, what does the return of that portfolio look like over time? Well, it turns out that it does beat the market, and it returns about 2.6% per year more, which is pretty solid outperformance. If you look at the relative performance, you find that it has a pretty steady uptrend with this big dislocation in the .com bubble, where it went up and then back down, full round trip. And that's not altogether unsurprising, but does kind of point out a key weakness in the strategy, which we'll address, I guess, later.
Okay. And the cool part, listeners, is you can go, this sucker goes back all the way to the 1970s, which is fun to kind of look back on kind of what's going on. So what's all right, so you got to put on your you referenced this earlier, like this possibility of inefficiency. What's the explanation? You got two that you propose as possible. What do you think is the best reality?
It's got to be a bit of both. So just for context, there's two explanations as to why we have this outperformance. The first is just the market's inefficient. Right? The simplest explanation. These assets are undervalued, they're misvalued, they're hard to measure. The Wall Street's very short-term focused, and they don't value, the kind of world-changing impact over long periods of time of technology. The second explanation is risk premium, that deep technological research is inherently risky. It's inherently boom or bust. You put in, Zuckerberg's out there putting $10 billion a year into metaverse, that could make Facebook into a $10 trillion company or into a zero, right? And investors are pushing his P ratio down as a result of that aggressive bet. So which of it is it? It's a bit of both. The narrative today is all that, innovation investing is just a rebrand of growth. That all these guys are doing is growth investing and like putting a fancy name on it. Is that actually true? Well, we can test the beta of the factor now, going back to the 70s to growth. And the first thing you find actually is that it's on average not been that high. It's only been 0.18. And moreover, you find that it fluctuates quite significantly through time. At GMO, we used to do these charts, the value of value, right? We look at the spread between value and growth stocks, and then look at how that spread evolves through time and to figure out, is it cheap or expensive? So you can do the same thing here with any basket of stocks, in this case, innovation companies. Are they cheap or expensive? Well, what you find is that the beta peaked in 2000, basically, in the tech bubble, because what happened was that innovative internet stocks became expensive because people said, this internet thing is amazing, I want to buy all these stocks, and then the valuations went up. And that's, by the way, what led to the drawdown that I pointed out earlier. The interesting thing you also find is that this number has trended down over time. Like it actually is at like a local minimum now. And what does that mean? I think the reason why is that at this point, the idea of using innovation and disruption is like mainstream. Every company is embracing innovation. And by the way, the most innovative companies by many measures are the biggest, most profitable ones. Like Google has as many patents, more patents actually, more publications in AI than Stanford and MIT, the next two highest combined, right? I mean, they are outperforming as a private institution the leading academic organizations in this country, and that's a pretty big deal. So I think the characteristics of these companies has changed. Innovation is not the same as it was before, not with the flaky.coms as it was before, and it will likely change again in the future.
So I'm just kind of, upset that I see you think that Chipotle is non-innovative. Have you seen some of the new offerings they've been putting out lately?
What is your favorite? What is your favorite menu item at Chipotle?
Well, I'm joking, because I actually don't eat Chipotle anymore, because they opened up near our office years ago, and then we used to go there all the time, and then it just happened where there was just like this total, refractory period where no one could eat anymore because we just topped out on Chipotle. So I don't know if I've been back. They have amazing chips though, really great chips. But anyway, okay. So, we walk through, there's some sector French Fama betas we could talk about, but you kind of, you talk about, really the most famous of the quote, disruptive, innovative funds. You talk about ARK and kind of where the factors lie. Are there any surprises there, or is sort of this strategy versus ARK, are they one and the same, and do all the factors play out in the way that most investors think it would play out?
No, actually the results here were a bit counterintuitive. So the first thing I said was, why is it that this innovation factor has not had a bigger drawdown the past year? Because the common narrative, a common conception is that innovation stocks are in this massive drawdown, as exemplified by ARK's performance. So we said, well, the only way to solve this puzzle is to go into ARC's performance and kind of figure out what's going on here. So I do this Fama-French decomposition and, break down its returns over the past, I guess, 7 or 8 years into 5 different buckets. So 4 different buckets. So it's market exposure, style factors. So that's like value and growth, and size and profitability and momentum, and then innovation. So it's exposure to innovative stocks. And then finally is alpha. So the first thing you find is that, ARC has made 12.4% annualized from its beta, which makes sense. The market's gone up. You also find that it made about 4.2% annualized on innovation. Kathy was very prescient in saying that this factor is something that, makes sense to put into my portfolio. This was many years ago. And even more impressive is that its alpha was 5.4% annualized. So we're saying that, look, they're taking a lot of active risk, but it's paying off. This is net of fees. So they're actually doing quite well finding the winners from amongst the innovation universe, right? Tesla. Now, here's the problem is style factors. Style factors for the first, 5 or 6 years of the sample were actually a positive contributor. But over the past year, it's just been disastrous. I mean, it's been, 40 to 50% drawdown. Like, let's imagine that 80% of their losses the past year has come from style factors. And then if you decompose that further, what you find is that it's really 2 components of the Fama-French style factors that are really killing them. That is growth and junk, or low profitability. So the way I frame this is, look, ARC is making a bet on innovation, but they're also making a bet on growth stocks and junk stocks, right? They're buying, these speculative companies at very high valuations, without any profits or even revenue in some cases. And that factor tilt has been what has kind of led to a lot of their pain the past year, not necessarily the innovation piece.
Yeah. If you were to look at an innovation basket, this might be a good time to segue into the next one, but we may be too early and out of order. Do most of the innovation sort of names, are they screening? I guess we talked about it earlier on the growth versus value, but are they screening particularly interesting at this point, do you think? Or is this a useful segue to talk about DARP, which, let's see, is that ticker taken? You reserved DARP yet? Anyway, help me expand to the next section, because I don't want to skip over anything important.
No, I mean, look, the only point I would make now is that where are we now? Let's take stock of where we are now in this paper. We have established that innovation has positive long-term returns, and moreover, that it is distinct from growth, technology, and other Fama-French factors, right? It is like a unique asset class in and of itself, a unique factor, an undiscovered factor that, as you were saying earlier, could be like a 6th Fama-French factor, right? This is its own thing. And that's really cool. What's the problem? Well, the problem is that oftentimes, as we saw in that chart of the beta, oftentimes innovation stocks are prone to being caught up in these bubbles. We saw that in the .com, and if we were able to take the data back even further, we'd likely see that in the Industrial Revolution, the Railroad Revolution, canals, Model T, etc. So how do we
coming full circle to your bubble days, man? You got this beautiful bubble chart that looks a lot like your old buddies on canal companies, UK railways. Man, these are beautiful charts. Information age is that people go bananas every once in a while.
And it makes sense. I mean, the allure of innovation is very seductive, right? If we think that, let's say Web3 is going to, be the new internet and completely change the technological paradigm, then we're likely going to be very interested in throwing some money in it. And that's just the way humans are. And it doesn't mean you shouldn't do it, right? Because the opposite of doing that is to say, I'm so afraid of potentially getting caught up in a bubble that I will, I'm just going to sit out innovation in general. And I never buy any stocks that have any potential for being world changing, right? So you need to kind of balance those things. And that's where DARP comes into play, because we think it's a way you can thread this needle, stay invested in innovation, yet avoid the most overvalued speculative stocks using these valuation metrics.
So do you do it where you skim off the really expensive, or you're concentrating in the cheap? What's the approach here for DARP? Great name.
Yeah,
What does that stand for?
So DARP is disruption at a reasonable price. Obviously, it's a play on Warren Buffett's claim, but far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So it's GARP, but DARP.
Yeah. I like it. Okay, so tell us what that means and how does that actually play out?
Yep. So what we do is we say, let's not just buy all of the innovative companies. Let's look within that universe and rank them on their innovation yield, which in this case, similar to what I described with the intangible value scores, we look at the number of innovative patents divided by market cap. So this forms a score for like how much innovation are you getting per dollar invested. Again, it's a value yield. And then what we do is we take the most expensive stocks, the worst performing stocks on that thing, and lop them off, and they're done. And then we just take the remaining ones. So that's only disruptive companies at a reasonable price. And what we find is that the value characteristics of that portfolio increased dramatically. The basic innovation portfolio had an innovation yield of 13%, and now goes to 49%. And then all the kind of traditional value metrics like price to earnings, sales yield, they also go up. Right. So we're able to get like a decent improvement simply by getting rid of the most overvalued companies within the innovation space.
And not surprisingly, given everything we know about markets, I love to see that free cash flow yield, baby. Does anyone else publish patent yield? Is that just you? I don't know if I've ever seen that anywhere.
I have not seen it elsewhere.
It's cool. All right, so drum roll. I'm guessing getting rid of the crazy expensive helps.
It does help. I mean, it does increase returns, but the big thing is that it helps with like the drawdowns. Then that's the reason why, right? Sometimes the best offense is a good defense. In the .com bubble, it's impossible there's nowhere really to hide. So let me just say that, but like it does help a lot. It helps reduce the drawdown. You get back to your high watermark 2 years earlier. And then in the current episode this past year, there is no drawdown because you have managed to avoid the Zooms and teledocs that are down 80%, and instead buy firms that are still engaged in innovation but are average price, like normally priced.
You guys, you talk a little bit about, and it's a beautiful equity curve. Listeners, you can check it out again in the paper. But I love this strategy. I love this idea, by the way. I think it's really super cool.
Thanks.
What's the overlap with some of the concepts we talked about earlier? Is this something where there's a lot of kind of philosophical, commonalities to the intangible value ideas? Is it something where there's a ton of overlap, not much? They look kind of similar or different? What's the story?
Yeah, this concept is a subset of the intangible value framework. The way I would say it is, what I've created here is a innovative patent yield, a way of identifying companies that are engaging in innovation in their patents. Now, patents, of course, are just one form of IP, right? Because as a company, I can choose to innovate, but then keep it as a trade secret, or frame it in a different way outside of the patent, legal system. So I view this whole edifice that I built in this paper as being one subset of IP, which of course is one subset of the 4-pillar framework.
Yeah. And so by definition, it's going to have some definite commonalities.
Yes. So the correlation, I did run this, of this factor, which by the way is part of the IP factor, so of course it's going to be high, is 81% with IP, but is close to 0 with the other 3 pillars.
Oh, that's interesting.
Right, because look, that's interesting because these are all 4 distinct concepts, right? So brand, for instance, what companies that have high brand are like your Nikes, your Chipotles, right? They have good brand, or they used to maybe. They don't necessarily have great IP. And firms with, say, very strong human capital, like your McKinseys and Goldmans, don't necessarily have strong IP either. So I view these 4 pillars as being kind of uncorrelated, distinct concepts, which is part of the reason why it's so important to not just have innovation as an asset class. Like the whole point of this paper is to say, you should do this, but then at the very end, I'm like, but also don't just do this. Like if you buy this argument, just go one step beyond, buy all 4 pillars, because in doing so, you'll now have a place to hide when innovation becomes expensive. In the dot-com bubble, all innovative stocks were expensive. There's just nothing you could do. You could use DARP, it would help a bit, but you're still kind of in a tough place. But if you own the other pillars, then you can just rotate your capital to the other sources of value today, say brand, human capital, right? I have this quote here that, look, like genius alone has never been enough to drive commercial success. History is littered with brilliant ideas that failed due to the inability to raise capital, attract talent, build brand, or bootstrap network effects. So look, IP is very important, but it should just be one piece of like a larger puzzle.
Yeah. You know, you watch that old documentary on even Tesla, the dude's in the news every day, but you know, where he talks about almost going bankrupt like hours. I mean, it may have been days, but it was certainly like hours away back in the Roadster 1.0 days. But fascinating is you look at a lot of these ideas and companies, and I look back, you know, even now to thinking about the ones that made it, the ones that didn't. I mean, here we are with TikTok and YouTube versus Vine. As we talk about Twitter, you know, Vine being the early entrant there that got put out to pasture, but you know, could have been a bigger market cap than Twitter if they just kept it open. Some of these ideas, but but that's creative destruction. You know, that's part of all this fun game we play. So the strategy, like what's here we are and you know, combining the main, coming all full circle back to your original concept of which this is one piece. Is it saying particular areas or ideas that are attractive today?
Look, I mean, the long-term story of innovation is you want to be long, and you do want to step out when things get super crazy, as they did in .com. But other than that, just being strategically tilted towards innovation and trying to just avoid the most expensive companies, right? Using this DARP approach has worked, and it's worked pretty well. And again, if you blend it with other pillars, you're going to be, you know, even better off. So that's very much like been the focus of our kind of intangible value research.
How challenging, and it seems like you guys potentially include some ADRs in this. You can correct me if I'm wrong, but how challenging is this to replicate internationally, if at all possible?
It should be quite possible because you know, there's the U.S. Patent and Trademark Office, which is the database I focused on here, and then there's, you know, a bunch of other ones, and then there's these like aggregators where all the data kind of sits, and there's, you know, a lot of reciprocity. A lot of companies, for example, that patent in the US are international companies, right? Because if you're Samsung or Sony, you're going to want, if you want to sell into the US market, you're going to want a patent in the US market too. So it should be pretty doable to scale this globally.
Yeah. Very cool, man. Well, we've been at this for a while, so let's start to try to wrap this up so you can be released into the Brooklyn evening. We look out to the horizon, man. You've been cranking on a lot of papers, a lot of ideas. This one obviously just hit the hopper, but as you think about putting pen to paper next time you come out and we're having sushi, what are you thinking about? What's got you excited, confused? Obviously you're building a emerging money manager, and that's your day job, but is there any research ideas, things that are on the brain currently that you're thinking about?
I think you hit on one very interesting point, which is so far a lot of my research has been very US centric, which makes sense, right? Because the US is the single most intangible rich market. You know, Europe and Asia, South America, you know, Africa have been less innovative than the US over the past decade. But, you know, time only moves forward, and it would make sense as an investor to, you know, also be able to figure out how to access intangible value abroad. And one of the very interesting and cool things about my framework here is that it's all based on statistical machine learning, statistical natural language processing, which means if I want to, you know, go to Japan, let's say, and start like looking at the filings there or whatever, I don't need to go hire a bunch of like Japanese speakers, Japanese linguists. I can take my model, which is currently been trained at the base layer on all of English Wikipedia, and then just train it on the Japanese corpus. Maybe it's Wikipedia, maybe it's not. And then you can do that in Thailand and in Vietnam and all over the world. And that makes what we're doing in the US so portable, so easy to scale, right? That was why I spent 2 years building technology, because it becomes just very easy to then kind of scale it to the next tier after you make that upfront investment. And by the way, if you do that, I think there's, a lot of alpha, right? Especially in emerging markets where, a lot of information is in English, but if you're in Thailand, a lot of the information will not be in English. And to the extent where you can, get that you can kind of comprehend that information in a way that a lot of the bigger funds, it's not really worth their while to put boots on the ground there to do. That's a pretty big source of edge.
Yeah, I mean, that's certainly an obvious extension of all the work you're doing in areas where it's not as efficient. I mean, expanding this abroad, super cool idea, as particularly those markets evolve too. A lot of the emerging in particular is a little more traditional, but things are changing so damn fast that it'll be fun to watch. What's been your most memorable investment? You look back in your career, anything come to mind, good, bad, in between?
I got a good one for you, Meb.
Great.
All right, most memorable investment. So, I got married a few years, and as part of the whole ritual, I had to buy like a diamond for my wife to kind of signify my commitments or whatever, right? And but as a value guy, what I didn't want to do was to like walk into the nearest jewelry store and like get my face ripped off. So instead, as any good quant would, I went online and web scraped a bunch of databases. It turns out that a lot of these diamond vendors like have their entire inventory online. So I just pulled all these data. I have now a spreadsheet with hundreds of different diamonds, where for each diamond you have like the properties. So it's like the 5 C's. I think it's like color, clarity, cut, something like that, right? Carat. And then I built like a 5-factor model where you predict the price of a diamond as a function of the 5 C's. And then what I did was look for residuals. Imagine you have a scatter plot and you're looking for things that are below that line. I found the few diamonds that were below, the most arbitrageable, whatever, and the one that was in my price range, and bought that. And what was so gratifying was I had to get appraised for like insurance purposes. And when I did that, it was like 50% higher. So I literally found a diamond in the rough. And my wife's gonna be super thrilled that I mentioned this on air.
So how long till the Diamond Arb private fund, where you just set up this is like crypto? It's a little too physically risky. You might get some guys coming after your kneecaps at some point. You publish all the secrets of the diamond industry trading. I've seen a lot of pitches in the last 5-10 years on sort of the what do you call it, artificial diamond production, whatever the right word for that would be. Growing seems to be not the right word, but some of these online platforms, they're for a long time. We did this, oh my god, how many years ago was this? We did a ETF contest where people would submit ETF ideas, and obviously a lot of them were crazy and silly. Many of the ideas have since launched. There used to be a lot of Swiss cheese hold in the ETF landscape. They get to be smaller and smaller by the day, but for a while there was a diamond ETF filed, but that it never came to market. I don't know how they'd possibly do it other than with swaps or something, but
it was like a GLD type thing.
People are trying. Yeah, I don't know what the sitch is, but it was filed. So who knows? We'll see if that ever makes it to market. But the diamond ticker DIA is already taken. Kai, this has been a blast, man. I love reading your research. Where do people go? They want to keep up with what you're doing. We'll obviously post all these in the show note links. But where do people find more about you and what you're up to?
Yeah, just check me out on my website. That's sparklinecapital.com.
Awesome, man. It's been a blast. We'll do this again soon. Thanks so much for joining us.
Good times. Thanks for having me, Matt.